A staggering $111.18 billion in Q2 revenue was just reported, yet Wall Street remains quietly anxious about future profitability. How does Apple achieve such massive top-line growth while facing unprecedented regulatory hurdles across global markets? We must figure out if this represents a genuine growth resurgence or a structural ecosystem decline. When you look at that Q2 revenue of $111.18 billion, it represents a robust 16.6% year-over-year revenue growth rate achieved despite economic uncertainty. A closer look reveals that iPhone revenue surged 21.7%, reaching an impressive $56.99 billion. At first glance, the observer assumes this is standard demand for basic consumer hardware. But digging into the product mix, consumers are heavily favoring premium hardware, specifically the high-end iPhone Pro models. The golden rule here is that pricing power always outweighs sheer sales volume when analyzing a mature technology company. Apple proves that upselling existing users works, which is a core dynamic you should always verify. So how is Apple keeping profits incredibly high when physical supply chain costs are steadily rising? The answer is that total gross margin quietly expanded to 49.3%. During this most recent reporting period, the crowd complains about hardware saturation, completely missing the hidden digital engine where the actual operating profit is generated. To understand that engine, we see Apple reported a remarkable services gross margin of 76.7%. This incredible figure means digital offerings like iCloud storage tiers are fundamentally changing the business model. Apple is transforming into a high-margin software toll bridge that effectively monetizes every single digital interaction. For your portfolio strategy, this shows precisely why tracking gross margin trajectory predicts long-term success better than top-line sales. Once you grasp how that 76.7% services gross margin completely changes the math, you will view financial reports differently. This rapid shift in profitability brings us right to the biggest elephant in the room, which is artificial intelligence. Operating expenses are climbing fast as the company pivots, with research and development expenses skyrocketing 34% year-over-year to hit $11.42 billion. This R&D spend captures exactly 10% of total revenue, signaling a structural internal reallocation of capital resources. Most analysts are purely focused on the perceived delay in Apple releasing flashy new software features. The crucial lesson here is that true innovation requires massive capital deployment long before it yields consumer-facing software capabilities. You simply cannot build the future of localized computing without buying the expensive physical servers first. To truly understand how Apple affords this massive infrastructure pivot, we must carefully examine its balance sheet liquidity. Over a 6-month period, free cash flow reached a phenomenal $78.28 billion, entirely defying expectations of an operational slowdown. This translates directly to an elite free cash flow margin of 30.7%, which is practically unheard of today. The consensus view often looks at this and mistakenly sees a big tech company lazily hoarding unneeded cash. But this $78.28 billion in free cash flow actually represents an impenetrable financial cushion against unexpected supply chain shocks. Apple uses this exceptional liquidity profile to aggressively fund internal operations without ever needing expensive external debt markets. The main takeaway is that a high free cash flow margin effectively protects your downside during unexpected economic shifts. So what exactly does Apple do with all of that excess cash sitting on the books? The answer lies in their aggressive share repurchase program, which recently deployed $36 billion to retire 135 million shares. Amateur commentators are frequently captivated by flashy external acquisitions, completely dismissing buybacks as simple financial engineering. But Apple just announced a monumental $100 billion share repurchase authorization to take even more equity off the open market. Or by constantly shrinking the outstanding equity base, Apple mathematically increases the fundamental value of every single remaining share you hold. This newly authorized $100 billion effectively acts as a highly reliable psychological and financial floor for the underlying stock price. It clearly shows executive management believes their own shares remain the absolute best long-term investment available. However, to fully grasp the broader risks facing the company, we must look well beyond the physical hardware elements. The historical financial perfection of the App Store is currently colliding with intense legal scrutiny worldwide. This growing regulatory pressure is marked most notably by a recent €500 million fine in Europe over platform distribution practices. Many casual investors are suddenly worried that new compliance mandates will permanently fracture this highly lucrative software distribution model. If Apple is forced to aggressively adjust its internal fee structures, that incredible service's profitability could face immediate downward pressure. But the daily reality is that the Apple ecosystem remains incredibly sticky, and alternative distribution models face massive consumer friction. Regulatory headlines create terrifying short-term noise, but they rarely destroy a deeply entrenched consumer monopoly overnight. While Europe presents these annoying regulatory headaches, another absolutely vital geographic region is actively defying all pessimistic expectations. Over the last 6 months, Greater China revenue delivered a staggering 33% year-over-year growth rate that shocked the broader market. Pundits aggressively painted a bleak picture of local Asian competitors completely crushing Apple demand across the region. Yet this 33% surge in regional revenue entirely neutralizes those pessimistic concerns and proves the doomsayers completely wrong. Apple is clearly proving that its premium brand positioning remains highly desirable to global consumers, regardless of shifting localized sentiments. It reminds us that verified financial data cuts right through market pessimism every single time you apply it correctly. Of course, we cannot ignore the physical constraints of manufacturing millions of complex devices for a global audience. Management explicitly warned about an escalating cost of goods sold, primarily driven by advanced semiconductors and highly specialized memory components. As Apple prepares to launch new premium products, severe component inflation could significantly compress future hardware margins. We also see a rare, quiet vulnerability hiding inside the broader hardware ecosystem that deserves our immediate attention. 6-month wearables, home and accessories revenue remained completely flat at $19.39 billion, showing almost zero upward momentum. This stagnant $19.39 billion figure suggests that inflation-weary consumers are actively deferring discretionary upgrades for secondary products. Finally, we must consider the ultimate measure of bottom-line corporate efficiency that drives real shareholder returns. Net income successfully translated to a diluted earnings per share of $2.01, representing a substantial 21.8% year-over-year EPS growth rate. Notice carefully how the 21.8% EPS growth comfortably outpaced the 16.6% total revenue growth we discussed earlier. This dynamic perfectly illustrates exceptional operating leverage, showing the company can efficiently extract more profit from every single dollar earned. When earnings per share grows noticeably faster than total revenue, you know the underlying business engine is running with minimal friction. Apple masterfully decoupled its core profitability from pure hardware volume, protecting long-term investors from temporary physical sales slumps. Even if physical device upgrade cycles stretch noticeably longer, the new $100 billion buyback authorization provides a massive safety net. Apple is actively paying the upfront costs for the next decade of spatial computing, entirely funding it with internal cash. Do you think buybacks justify this valuation, or is the hardware slowdown a hidden red flag? Let me know in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.